In July 2021, Elon told Tesla shareholders he was done with earnings calls. He would skip them unless something really important came out. But he has shown up to almost every one since. That is not a broken promise. That is a public company asserting itself on a CEO who thought he could step back. Now multiply that by 2. 2 earnings calls, 2 boards, 2 sets of shareholders asking questions about the same chips, the same capital, the same decisions. Jack Dorsey ran this exact structure. His way out was to leave Twitter. Elon cannot leave either company. The merger is not a vision, it is the only exit. Every analyst covering Tesla right now has a version of the merger story. Dan Ives at Wedbush puts the probability at 80 to 90%. His logic: AI, autonomous systems, and the 2 companies being worth more together than apart. That is not wrong, but it is not why the merger is inevitable. The merger is inevitable because 2 companies with 1 CEO is a structure that cannot hold. Not because of what the companies build, because of what a public company demands from the person who runs it. Running a public company is not a management choice you can scale back. It is an obligation that repeats every quarter. Earnings calls, official reports to shareholders, answering to a board of directors. You do not get to decide when the company needs you. Elon already tested this. He announced in July 2021 that he was stepping back from earnings calls. He showed up anyway, quarter after quarter, because the structure left no other option. Now he is running 2 of those structures at the same time. The merger does not come when the vision is ready. It comes when the obligation becomes the argument for it. One detail from Tesla's most recent earnings call before I go further. A shareholder asked Elon directly, when resources move between Tesla and SpaceX, how does that get decided? He said any deal between the 2 companies has to go through a conflict resolution process. Board members with no ties to either CEO have to sign off from both sides. A check, he said, to make sure both sets of shareholders are served. He named no committee. No written ruling from this process has ever been made public. Hold that, we are coming back to it. 2 public companies means 2 separate sets of people whose job is to hold Elon accountable. When a decision helps one company and hurts the other, both groups have to weigh in separately. That friction has already produced a lawsuit. In June 2024, the Cleveland Bakers and Teamsters Pension Fund filed a case in Delaware against Elon Musk. The reason: 12,000 NVIDIA H100 chips, already ordered by Tesla, already shipped, had their delivery redirected. They went to xAI instead. Elon confirmed the redirect publicly in June 2024. He said the chips would have sat in a warehouse if they had arrived at Tesla. The fund alleged he broke his legal duty to Tesla shareholders by doing it. That case is still active as of April 2026. That case exists entirely because of the 2-company structure. 1 company, 1 board, same chip decision. It is just a spending call, no court involved. Now back to the conflict resolution process Elon described on the earnings call. No named committee, no written rulings, a verbal description of a process given under shareholder questioning about decisions that are actively being litigated in court. That is the oversight system in operation right now. If this breakdown is useful, hit like. It genuinely helps these rich people who needs it before they make a decision. Subscribe if you have not already. This structure has existed before. 1 person, 2 public companies, simultaneously. The pattern already ran its full course. We have the complete record. Jack Dorsey became the permanent CEO of Twitter in October 2015. The same month, Square launched its IPO on the New York Stock Exchange. He was immediately the CEO of 2 publicly traded companies at the same time. His ownership in each was not equal. He held approximately 2% of Twitter. He held 24% of Square, with enough voting power to override anyone else in the room. Over the next 6 years, Twitter's stock went essentially nowhere. Square returned more than 1,500%. the friction built exactly the way it is building now. Twitter shareholders filed a lawsuit in Delaware. The allegation: Dorsey's ownership gap created a financial incentive to put Twitter's interests second. The specific claim was that he gave advertisers access to Twitter user data in ways that directly benefited Square's revenue. Eloy management took a stake worth approximately $1 billion in Twitter in early 2020. Their goal was to remove Dorsey as CEO. The divided attention was the stated reason. The negotiated 2 board seats. Dorsey kept his job. Nothing changed. And then there is Peter Zatko. Zatko joined Twitter as the head of security in late 2020. Over the following year, he and Dorsey had 6 phone calls. Each one lasted under 30 minutes. In an entire year working together at the same company, Dorsey said approximately 50 words to him. Zatko described this in his whistleblower testimony. His conclusion: Dorsey's behaviors was, in his words, anomalous and unhelpful in summoning the Herculean effort to fix Twitter's problems. During that same year, Square was one of the highest performing stocks in the market. I want to be clear about what that detail tells you and what it does not. It is not evidence that Dorsey is a bad person. It is evidence of what happens when one CEO runs 2 companies and one of them is putting far more money in his pocket. His ownership was 24% of Square versus 2% of Twitter. Attention followed the money. The outcome was predictable from the structure. Dorsey resigned from Twitter on November 29, 2021. Within minutes of the announcement, Twitter's stock price jumped more than 10%. The market did not wait for a new strategy. It moved on the single piece of information that one CEO was finally running one company. That reaction is the market's complete verdict on 6 years of divided attention delivered in real time. Dorsey resolved the structural problem by leaving Twitter. This worked because his 2 companies had nothing in common: social media and financial services. Separate engineering teams, separate customers, separate buildings. Walking away from one did not damage the other. Elon does not have that option. Tesla and SpaceX share engineering talent. Tesla's money is inside SpaceX as an ownership stake. They are co-building a chip factory in Austin, Texas. xAI's AI is now powering Tesla's Optimus robots. These are not partnerships. They need each other to function. If Elon stepped away from either company, the connection to the other would make it harder to run, not easier. And beyond that, Elon holds approximately 16.8% of Tesla and approximately 43% of SpaceX. Tesla is his largest liquid asset. SpaceX is his biggest single private investment. He cannot afford to walk away from either one. Dorsey could leave Twitter because the company his wealth depended on was somewhere else. Elon's wealth depends on both. The only move that resolves the structural problem without anyone leaving anything is the merger. Not because of the vision, because of what remains when every other option is ruled out. 3 decisions in the past 6 months read as a single pattern when placed side by side. Tesla moved a $2 billion position in xAI into SpaceX ownership. Tesla's resulting stakes in SpaceX, less than 1%. The exact figure has not been disclosed in any filing. Tesla shareholders funded a SpaceX position whose precise size they cannot calculate from public information. In March 2026, Elon confirmed the Digital Optimus project, xAI's Grok AI powering Tesla's Optimus robots. This is the same category of AI connected across both companies that the Cleveland shareholders are actively dedicating. The announcement came while the lawsuit was still open. Terafab, a $25 billion chip factory, jointly built by Tesla, SpaceX, xAI, and Intel. Tesla's shares of the ownership has not been disclosed. Tesla's CFO confirmed the full cost is not yet in Tesla's spending plan for 2026. Each of these decisions is exactly what a merged company would do internally. Money moving between entities, AI systems connected across corporate lines, capital committed with no full public accounting. The difference under the current structure: each one creates legal risk. Each requires the conflict resolution process Elon described. Each one can become the next lawsuit. After the merger, every one of these decisions become an internal call. No sign-off required from board members across two companies. No legal right for shareholders to sue across separate entities. No requirement to tell anyone the terms. Some of you are already at the next question. If the merger is inevitable, should I be buying more Tesla or selling before it happens? There is a different question worth sitting with first. What do you currently hold as a Tesla shareholder that you will not hold after the merger? Right now, you have the legal right to sue. When a Tesla resource moves to SpaceX without proper process, you can take it to court. The Cleveland Pension Fund is doing exactly that. Your position as a Tesla shareholder is what gives them that right. After the merger, the right dissolves into the combined company. You become a shareholder of one entity making spending decisions internally. Those decisions do not require reporting between two separate companies. The mechanism you currently hold disappears. The 54-point gap between Dan Ives at 80 to 90% and prediction markets at 26% is not a disagreement about whether Elon wants to merge them. It is the market pricing in government approvals, checks on whether the combined company gets too powerful, and shareholder votes at both companies. Both numbers can be accurate at the same time. They are answering different questions. What either number tells you is what changes for you the moment the structure does. 3 things I'm watching. 1. The SpaceX IPO filing, expected summer 2026. The moment SpaceX files to go public, a second group of shareholders gain the legal right to challenge Elon's cross-company decisions. Watch how quickly the first governance event surfaces after that filing drops. 2. The Delaware ruling on the GPU lawsuit. A decision before any merger announcement sets the rules for every cross-company move in the pre-merger window. A ruling against Elon accelerates the pressure to resolve the structure. 3. The next Tesla earnings call. Elon described a conflict resolution process in April 2026 with no name committee and no public record. If a name structure appears in any future filing, the friction has become too visible to handle quietly. When I found the earnings call detail I mentioned at the start, that Elon described a process with no public record of ever producing a single ruling, I did not think about what trade to make. I thought about how many decisions have already moved through that same process with no visible check applied. In July 2021, Elon told shareholders he was done showing up to earnings calls. The structure of a public company did not agree. He found himself there every quarter, answering questions he had already said he would not be present to answer. 2 companies means 2 of those structures holding simultaneously. The merger does not come because someone decides the timing is right. It comes because the structure runs out of room to hold. When the administrative weight of 2 public companies finally becomes the reason Elon acts, not the vision, not the synergies, just the obligation, will you have understood that was always the clock? If this breakdown was useful, hit like and subscribe. I go 3 layers deep every week.